Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Virgin Galactic.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. StockAnalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So imagine watching a stock just, completely explode overnight, gaining 14% in after-hours trading.
Which is wild.
Right, and not because their engineers launched some revolutionary new spaceship, but basically because a group of lawyers finally packed up their briefcases and went home.
Yeah, that is exactly the bizarre reality we're unpacking today with Virgin Galactic.
The price action over the last couple of days has been, nothing short of violent. On May 28th, 2026, the stock surged that massive 14% after the bell.
And it didn't stop there.
No, it didn't. It followed right up with a 9.9% jump in the pre-market the very next day. We're talking about a massive, aggressive gap up. And the trigger, a major legal cloud vanished. They settled these long-standing derivative actions.
Exactly. And that kind of momentum is just impossible for the market to ignore. When you see a 14% spike followed by sustained pre-market strength, you're literally watching a momentum-driven floor being built in real time.
Right. But for anyone listening who might be wondering what a derivative action actually is, it's essentially when shareholders sue the company's own insiders.
Yeah, usually the executives of the board.
Right. They sue them on behalf of the company itself, claiming gross mismanagement or, breach of fiduciary duty. It creates this ugly cloud of legal uncertainty.
And the market absolutely hates uncertainty.
Yeah.
Especially the legal kind, which has been aggressively hanging over this stock since its post-SPAC merger days. So by settling, that dark cloud is lifted, and you unlock this rush of enthusiasm.
Institutions get back in.
Exactly. A lot of institutional players have strict mandates that prevent them from touching companies tangled in governance lawsuits.
Right.
With that overhang gone, those massive buyers are greenlit to jump back into the pool.
I hear that, and an initial pop on a chart is always great to see. But as a practical, risk-aware investor, you have to ask yourself a really simple question.
Does firing the lawyers actually fix the rockets?
Exactly. Does avoiding a courtroom justify taking a long-term position in a highly speculative spaceflight company? Sure, the boardroom breathes a sigh of relief, but we have to separate a mechanical relief rally from the operational reality of a business trying to defy gravity.
That is a completely fair distinction.
Yeah.
So, all right, let's move into the wealth building context, because to really understand Virgin Galactic here, you have to completely stop looking at it as just a volatile space stock.
Okay, so how should you view it?
You need to view it as a classic binary catalyst play.
Yeah.
Right now, this company is deliberately operating in a pre-revenue cash burn phase. They've intentionally paused commercial flights with their current ship, the VSS Eve.
To pivot to the new fleet, right?
Yeah, to completely pivot their resources toward developing their next-generation Delta-class spaceships. So this is entirely a transition story. They're moving from a cash-burning testing phase into a highly scalable, high-margin commercial spaceflight business.
But wait, a transition like that is notoriously expensive. The aerospace industry is infamous for swallowing capital whole.
It is incredibly capital-intensive, no question. But look at the unique asset that protects them during this transition. They currently have a backlog of roughly 700 future astronauts who have already put down significant cash deposits.
That's a lot of locked-in capital.
It's a guaranteed demand pipeline. When you're trying to build brand new technology, having a captive audience of 700 high-net-worth individuals who've already opened their wallets is a massive luxury. It completely insulates them against near-term economic shocks while they scale.
Okay, I hear 700 deposits and I immediately think, sure, that looks fantastic on a presentation slide, but building a fleet of spaceships isn't like writing software.
No, it's heavy industry.
Right. It's much more comparable to extremely slow-moving infrastructure plays, like building a deep water port. You're building massive physical assets that require rigorous safety testing. Do retail investors actually have the patience for an industry that burns cash for years before it scales?
Well, that patience is exactly how thesis-driven investors capture outsized returns. Think about it. You don't build massive wealth by buying in after the operational inflection point.
When all the good news is already priced in.
Exactly. You buy in before the scaling actually happens. You endure that uncomfortable cash burn phase because you understand the sheer volume leverage that happens when those Delta-class ships finally come online. If you wait for it to be a mature cash-printing infrastructure play, you've missed the wealth-building phase entirely.
I mean, that strategy requires a lot of faith in their financial runway. You mentioned the backlog, but backlogs don't pay for engineering salaries today. So now let's look at the fundamentals.
Yeah, let's look at the cash.
Because if you're enduring a multi-year cash burn phase, you need to know exactly how much oxygen is left in the room. And looking at their Q1 2025 numbers, top-line revenue was an incredibly light $2.8 million.
Down from $3.8 million year over year.
Right. And against that tiny trickle of revenue, they posted a staggering GAAP operating loss of $112 million.
It's an intimidating loss on the surface, sure. But you have to contextualize it against the massive liquidity they've built up to absorb those specific losses. As of that exact same quarter, they had $867 million in cash.
Against only $21 million in debt.
Exactly. That is an incredibly clean, fortress-like balance sheet for a capital-intensive aerospace company.
Clean on the debt side, absolutely. But let's do the math on that liquidity. They're burning through roughly $110 million in free cash flow every single quarter.
Just to keep the lights on and fund the research, yeah.
Right. So if you burn $110 million a quarter and you have $867 million in the bank, simple division gives you roughly 8 quarters. That's exactly 2 years of runway before things get uncomfortably tight.
Which perfectly bridges them to their promised Delta-class launch in 2026. Management has explicitly engineered that runway to fund operations without requiring immediate dilutive equity raises.
That's a tight needle to thread.
It is. And when we're talking about cash flows, let's look at the mechanics of this derivative settlement. The insurers are actually paying the $2.75 million payout. Virgin Galactic doesn't pay a dime out of pocket.
Oh, wait, and the company keeps half of it, right?
Yeah, they retain an inflow of $1.375 million. Now, I'll admit, compared to a $110 million quarterly burn rate, $1 million is basically a rounding error.
Yeah, it's a drop in the bucket.
But symbolically, it's a positive inflow that totally offsets their litigation costs. Current management gets to walk away from this inherited mess completely absolved.
Symbolically positive, yes. But let's talk about the physical product, because if they're spending $110 million every 90 days, the product better be unique enough to dominate the market. Their whole moat is this runway-to-runway air launch system.
Right, the mothership Eve.
Yeah, carrying the smaller passenger spaceship up to a high altitude and dropping it. That's fundamentally different from traditional capsule and rocket systems like Blue Origin, which just blasts vertically from a pad.
And that difference is the core of their competitive advantage. Taking off horizontally from a runway inside an airplane is a much more accessible, gentle experience for civilian astronauts.
Which matters when your target demographic is wealthy 60-year-olds.
Exactly, not highly trained fighter pilots. The horizontal takeoff feels like a luxurious commercial flight right up until the drop. The G-forces are manageable, which significantly broadens their addressable market.
I understand the marketing appeal. But operationally, it's not just an aircraft carrier deploying a jet. It's a carrier doing a high-altitude drop of a rocket-powered glider at Mach speeds.
It's an intense maneuver.
Right. Every single time they do that, the sheer mechanical stress on the mothership's central wing is immense. You aren't just maintaining one spaceship, you're maintaining a massive mothership alongside it.
2 highly specialized vehicles.
Exactly. I really have to push back on whether that $867 million safety net is deep enough to keep both of these stress-heavy systems operational through development without running out of capital.
Well, the maintenance turnaround on the older equipment is exactly why they are overhauling the fleet. That brings us to the catalyst timeline. Because bridging the gap between today's burn and tomorrow's profits requires flawless execution.
And time is literally money here.
The single most important catalyst is the 2026 operational inflection point. That's when the Delta-class ships enter commercial service. You asked about structural stress. The old ships maxed out at maybe one flight per month because of intense X-ray inspection.
Which isn't a sustainable business model.
Not at all. But the new Delta-class ships utilize modular components and advanced composites designed for rapid reusability. Management expects to scale from one flight a month to 2 flights per week per ship.
Wait, 2 flights a week per ship? That's a massive jump.
I want you to really think about the sheer volume leverage there. You take a business with massive fixed costs and suddenly multiply your revenue-generating events by roughly 8 times a month without significantly increasing overhead. That shift is the fundamental pivot point for the valuation.
That's the dream scenario, assuming they hit the 2026 deadline. But before we even get to weekly flights, there are near-term events circled on the calendar, like July 28th, 2026.
The final settlement hearing.
Exactly. Official court approval will be a definitive psychological catalyst, closing this litigation chapter for good.
And right after that, in early August 2026, we get the Q2 earnings report. The market won't care about revenue. They'll be desperately listening for Delta-class manufacturing milestones. They want proof the ships are on schedule.
And beyond company events, we have to factor in macro tailwinds. Long-duration, pre-profitability stocks benefit immensely from dovish inflation data or rate cuts.
Lowering the discount rate.
Right. When institutional investors model valuation, they discount future cash flows based on current rates. When rates drop, the future value becomes mathematically much more attractive today.
It's a huge tailwind.
But consider the dark side. What if inflation stays stubbornly sticky? If rates stay high, the market brutally punishes cash-burning growth companies. If you're burning $110 million a quarter and rates stay elevated, the cost of any future capital raise becomes absolutely astronomical.
It crushes the valuation under the weight of capital costs. I get that. But if you look at the immediate price action, the algorithms are aggressively buying. Now let's pivot to the chart.
Because the technicals are definitely screaming right now.
We saw a violent break above key resistance levels with that 14% move.
Yeah.
Mechanically, stranded long investors are finally relieved. But more importantly, short sellers are getting squeezed hard.
They're forced to cover.
Exactly. To stop the bleeding, they have to buy the stock back at market price. That forced buying creates a self-fulfilling, momentum-driven floor. Our data even shows the stock trending under industrial stocks whale activity. Big institutional money is stepping in.
Sure, but you have to look at the RSI, the Relative Strength Index. It's sitting at a blistering 78.65.
Which is very high.
Anything over 70 is mathematically overbought. Think of an RSI of 78 as stretching an industrial steel cable as tight as it will go. The laws of market physics dictate it will violently snap back to find equilibrium.
You think it's due for a retracement?
I think chasing a massive gap up when the RSI is nearing 80 mathematically invites near-term pain. You're basically asking to buy shares at the exact millisecond short-term traders are locking in their overnight profits.
I hear the caution, and pullbacks are healthy. But you simply cannot ignore the heavy institutional footprint here. When you see verified whale activity on a major gap up, it often means smart money is positioning for a sustained multi-month move.
So what does market sentiment look like?
Right now, it is heavily bullish. The top news stories are universally validating this corporate governance cleanup. Headlines are completely focused on the removal of this legal overhang.
Institutions are free to buy again.
Yeah, institutions with mandates preventing them from touching litigation-heavy stocks are suddenly completely free to build massive positions.
And right on cue, whenever we see a price spike and whale activity, the speculative retail chatter ramps up to a deafening volume.
It definitely does. There's a lot of unconfirmed market chatter circulating. Some suggest a secret acceleration of the Delta-class rollout, but the really interesting rumor is about potential M&A interest, mergers and acquisitions.
Oh, here we go.
There's chatter that legacy aerospace players might be taking a hard look at Virgin Galactic. They see fully proprietary air launch IP and that captive backlog of 700 fully funded future astronauts. The theory is a major contractor might want to acquire all that demand at a steep discount.
I am incredibly skeptical of M&A rumors that magically appear the exact morning after a stock gaps up 14%. As an investor, you have to fiercely guard yourself against unconfirmed market chatter.
You think it's a trap?
Often, yes. In heavily shorted, narrative-driven names, rumors are deliberately floated to create immediate exit liquidity. The institutional whales who bought the after-hours pop need eager retail buyers to chase these shiny M&A rumors today so they can sell their shares at a profit.
That is a very cynical but very necessary warning. If we strip away the M&A noise, we have to look at the foundational threats. Now let's talk about the risks, because laying out the worst-case scenarios is mandatory before deploying capital.
Absolutely. Aerospace is an industry where gravity always wins eventually. So what is the worst-case scenario here?
The most immediate risk is what you pointed out, the overbought technical pullback. With RSI pushing 79, heavy profit-taking is highly probable. If you buy blindly into the peak, you're exposed to a sharp retracement.
And the longer-term risk.
Execution. The aerospace industry is globally notorious for brutal multi-year delays. Management targeted 2026 for the Delta-class launch. If they miss that engineering target, the financial math completely falls apart.
Exactly. Physics doesn't care about a corporate deadline. Engineering takes as long as it takes. Parts fail. Supply chains bottleneck. If they face even a one-year delay, that cash runway dries up incredibly rapidly.
Which leads directly to the ultimate bear case: severe dilution risk. If they run out of cash before the new ships are generating high-margin revenue, they'll be forced into an emergency equity raise.
Issuing new shares at desperate prices.
Yeah, which would heavily dilute current shareholders and crater the bullish thesis. However, we have to balance that by remembering their current balance sheet is statistically strong enough to bridge the gap as projected today. They have the funds if they execute on time.
If they execute on time, that's the multi-million-dollar condition. So with everything on the table, what's the final verdict?
Based on the deep research and technical setup, we're looking at a bullish score of 7. The thesis is that Virgin Galactic has successfully cleared a major legal overhang, igniting a powerful short cover rally. It's overbought near term, but fundamentally it remains a highly scalable binary catalyst play resting entirely on the 2026 Delta-class launch.
So for a balanced portfolio, view this as a swing trade setup leading into Q2 earnings in the July 2026 settlement hearing. Capitalize on near-term momentum. But for long-term viability, obsessively monitor every update on Delta-class manufacturing. Any whisper of delay changes the thesis.
It's entirely about watching that transition from the drawing board to the runway.
But before we wrap up, think about something even bigger. If Virgin Galactic succeeds and space tourism becomes routine, it transforms into a commoditized airline industry. Will the ultra-wealthy still pay a massive premium when it's no longer an exclusive club, but just a heavily scheduled roller coaster ride? The psychology of exclusivity might just be the invisible ceiling on this valuation. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.